You're listening to the Real Returns podcast, where we learn how real investments can make a real impact. Join your hosts, Andrew and Dan, as they share stories and interview business leaders on how real estate and other forms of investment can create meaningful change for individuals and communities around the world.
All right. Welcome to another version of the Real Returns podcast. This is Andrew Reichert, and I've got my co-host Dan Croce with me. Dan, it's been snowing here in Pittsburgh. You ready to roll for today?
Sorry about that, but it is a blustery day here in the Northeast, to say the least. But yeah, ready to rock and excited to be chatting with our guest Charles.
Yeah, well, Dan's having a bad hair day, so he insisted on video off. So, all right, cool. Yeah, well, I'm excited to introduce our guest joining us from somewhere warmer, which I'll let him fill you in on. But Charles Carillo is managing partner at Harborside Partners, and we're sort of like-minded and like business folks. So he's been doing the real estate syndication thing since 2006, and they've acquired over $200 million in real estate doing that. And Charles also has his own podcast, so the Global Investors Podcast. They've produced something like almost 300 episodes, right, Charles? So really awesome. Charles, I'd love if you would just maybe say a word or two about yourself.
Thank you so much, Andrew, for the intro. So I am originally from Connecticut, so I'm originally from the Northeast with you guys, and I'm down in Palm Beach, Florida area right now. That's where I live in Gardens. And I started investing in multifamily in 2006, and my father had been involved with multifamily investing since 1984. So he's been doing it for many decades. And he self-managed a lot of properties, and that was kind of my my education. My second education growing up was going with him to different properties that he was buying, that he was having managed. Never had a third-party manager. He always had like a team. And so when I got out of college, I bought my first, it was now we call it house hacking, but back then we didn't really have a name for it. And it was a 3-family in the end of 06. And then I bought again another 3-family in the end of 08. And then I bought a commercial property. And that was when everything was just going crazy. And got involved. Mm-hmm. We've been involved with syndication since 2018. And since that time, we've purchased over $200 million worth of commercial multifamily real estate.
Mm-hmm. Mm-hmm. Yeah, it's an awesome story, and it's cool to see how you've kind of grown from a small portfolio, and you've sort of made it through a bit of a recession. We were talking a little bit about that beforehand, but how are you thinking of that now that there's sort of talk right now of a looming recession? How are you thinking back to those early days of your business?
We're really focusing on all of our projects that we have going right now. It's really focusing on maximizing occupancy, maximizing collections, and minimizing any type of delinquency, which obviously you're doing that all the time. But when we're value-add multifamily people, we really want to, you're really going in there and doing work, and you're trying to really raise values. And at this point, we're really just we're keeping everything rolling how it is. We're going to do some renovations. We're doing very mild rent increases. Any kind of large projects that we've had, we're putting on hold, or we're doing them to a lesser degree. And really just kind of seeing what what 2023 has in hold for us. So.
Yeah. And in your business, are you doing more like heavy development, value add stuff, or more like lighter value add? And
over the last year, we've the deals we've done have been lighter value add. So the last one we did was a lighter value add deal, and that we're working on now. And then we have some ones. I wouldn't say we're not doing any heavy ones. We're not doing any major renovation deals. We have a couple that are, I would say, kind of medium, where we're putting in a little bit more work. We're doing some kitchens. We're doing bathrooms. But it's not something where we're developing or doing huge changes to a property.
Mm-hmm. Okay. And do you typically do any of that work yourself, or are you subcontracting that out, or hiring a general contractor?
We're going to have a general contractor on that we work with in that area that we're going to focus on working with, that's just going to do unit turns. So really us figuring out, because we still have some renovations we're doing. We had a property we bought early 2022, 157 units outside of Atlanta. And, we used to be doing 6 or 7 unit turns per month. 6 or 7 renovations per month. And now we're doing like 2. So I wouldn't say we're
Okay.
stalling the
Slow
project
down.
out of how we're doing it. We're just doing it on a slower level and making sure that there's always the appetite for these nicer units, because you have a lot of people that are, I mean, in all different, these are B minus, B class properties. You people want to stay in the properties. We want them to stay in the properties. They're good tenants. So when we have any type of people that are moving out, moving back in, we're going to have we're usually just really doing cleaning and painting and really getting ready that way. And then when we'll do a couple units here, if the ones that are in the worst condition, we're going to do the renovations too that are major. And then the ones that are okay, and we have tenants that are renewing or something like this, well, our goal is just, like as I said before, keeping them in there. And as we see what's in store for us later this year and 2024, then we can get back on track of what we're working on. But still increasing your net operating income and still getting the efficiencies of everything that really goes through, which isn't raising income per se. It's really just we're putting in new vendors that we have. We're putting in new property managing, all that kind of stuff.
Mm-hmm. Okay. And speaking of putting in new property management, remind me again, are you vertically integrated where you manage any of the properties, or are you always
We're using
a
third-party management right now,
manager?
and we are in 3 major markets that we're in right now. So with partners that we have on the ground in those areas, we have management that has been used by our partners, and that's what we really, when we do deals, we are utilizing their management and their team on the ground, and it makes it a little bit more streamlined for everything. And also, you're getting a lot of economy of scale right off the bat.
Yeah, that makes sense. And what's a typical hold period for you? Are you kind of get in and get out once you've added the value, or are you planning
now
on
they're going to
holding
be
these
longer term. And one we just went full cycle on in 2022, it was just under 3 years. But anything that we've purchased 2020 on, it's all been telling investors really 5 to 7 years. And I think that's really where it's going to be. Because if we have fixed debt on properties, we can really wait out what we're doing now and not have any kind of rush to people having to sell or having to refinance. So that's really a focus of what we're doing now.
Mm-hmm. And is that what you're finding kind of matches to your investor appetite as well? They like a 5,
I think
7 year
most
hold,
investors would
something
want
like
a shorter
that.
hold, but I mean, it just depends. I don't want to, overpromise, say we're going to be out of something in 3 years, and then, hey, the economy, it's better if we hold off for 5 years. So it's really just being upfront and tell investors, kind of paint a longer hold time as the picture, and then, probably I think 2024, 2025 will be exiting out of deals. We exited out a lot of deals in 2022. The first half of it, we exited out of 3 or 4 deals. So we really, when we see something like that happening again, probably not to that extent with the low interest rates and everything else, but we're always looking to, if buyers are interested, we will entertain them. And we have like one property right now in Tampa, and it's really like a pocket listing with one broker, and we have a number that we'd like, but we also have we're going on like another 7 years of fixed debt at like 4.05 or something. So there's no rush to sell anything, but if the price comes in, we'll do it.
Yeah, it makes sense. And timing is sort of everything. So kudos on the exit in early 2022. It seems to be when valuations were kind of peaking. Okay, well, that's really helpful. And how are you structured? Are these private funds, or how do you structure
So how
yourself
we've
from
done
an equity standpoint?
right now is we are focusing on doing it's just individual syndications, and we found with our partners that with our limited partners, our investors, that it gives a lot more power to them to choose the projects and the markets that they want to be in. And if the states they want to be in, the markets that we're looking at, and the type of properties.
Yeah, that makes sense. And what's a typical unit size for you for a syndication?
So, I mean, our first deal we did was 59 units, and right now I would say anything that we're doing is, our last one was 536 units, but I would say 100 plus units. I mean, I don't want to, I say 100 plus units. That's when you're going to have scale. That's when you have, Your on-site management is actually, you can really get economy of scale with your on-site manager. You go any lower than that, it gets kind of a little iffy, where you always have a little bit more labor than you really need, so it doesn't make as much efficiency. But I think when you're getting 100 plus units, that's when you have full-time people in there. You can have people there leasing 6 days a week or 5.5 days a week. You know what I mean? And I think that's the best that's really what we like. And we like buying in properties built in the 1980s, usually 1985 and newer. And just like better properties in B- and above areas. Yeah, that makes sense. What are some of the neighborhoods that you're in? We really like a couple places outside of Atlanta, and so we're very interested in that. DFW, Tampa, and like Jacksonville, Florida as well. So it's everything's got expensive in those areas, and we're seeing a little bit of a pullback on pricing, but I don't think the interest rates of where they are now have been fully priced in, and I think that's a pretty lagging. It goes with a lot of the brokers too. If they're selling a property, they want to get top price. They want to make sure that they're going to be a little slower unless the seller really wants to move the property, of lowering that price or suggesting to them, hey, you should lower this if we're going to get some more people in there. But properties are still selling. I see them all the time that are selling pretty low cap rates for interest rates right now. So every buyer and every seller, every buyer has a different business plan of why they're buying it and what they're doing. So something that doesn't fit for myself or you, Andrew, might fit for someone else. You know what I mean?
Right. Yeah, there's sort of buyers and sellers in every market, and certainly we've noticed that on our end as well. Seller expectations haven't really reset based on the interest rates, but it seems like stuff's still selling. So, cool. Well, the purpose of our podcast is really to talk about impact and the impacts of investing. The way we think about that is investors and our employees and the tenants that we serve. So I would love to just hear from you a little bit. How are you thinking about impact?
So
what
we've done with like impact investing, when I started investing, it was a lot of smaller properties, and I would buy them like small multifamilies, and myself and my partner, we would buy them in very close to each other. I think within a block, and I think the longest one we had was almost less than a half mile away. So really like different areas buying, and that's where you're going to be able to really improve the neighborhood. When you're buying properties, you have, for lack of a better word, you're getting out of slumlords. You know what I mean? And because you drive by something in like a C-class neighborhood, because most of these properties were all C, and you see it and you're like, oh, it's a beautiful property. It's just terribly maintained. It's someone out of state, and it's just run terribly. And I think when you're able to, the more you're able to do in a smaller area is where you're able to really make impact. And that's better for tenants that want to move into that area. You're going to get better tenants moving into that neighborhood, and it's better for the tenants that are already there. And because now everything's been cleaned up, and now they're, we were going to move out. Hey, maybe we're not going to move out. And so I think I always like that. Also, when you're buying properties and you have tenants that want to stay, and you're trying to figure, and you're like, okay, well, you can stay in this unit and you can renew it. We have new ones updated here that you can move into too. And that always makes me feel good, because you're like, we've done something where the person wants to stay. And it's difficult to, like, you're not going to have that conversation as having, being so many, not being, talking to the tenants one-on-one, being in the property management. But when you hear that and you see that on your like weekly list from property managers of what they want to do, and you see renewals and people moving to new units, mean they like the property, they like what we've done in the area, and now they really want to stay. So I think that's the best part of it.
Yeah, that makes sense. And I think that speaks a lot to, the care that you're showing for tenants. I mean, certainly it sounds like maybe the bar is pretty low with some of the properties you're buying, but the nice thing is you're coming in and showing that care. How do you think about that in terms of evaluating the property managers? Is that something you're thinking about since you're not actually managing them? Well,
Andrew, you probably see this too in like your business when you're looking at properties, and if someone's owned something, and I mean, I've been guilty of it too. You bought something, like you stole a property years and years back, you got a really good price on it, it's really gone up in value, and you're not as aggressive with it, you know what I mean, with what you're doing, with doing, as much CapEx as you should be or you could do to really maximize that property. And I see that kind of bleeds down as property management, because you're not pushing that property manager to hey, like, where are we right now with these projects, or what can we be doing to, to fix what's deferred. And I think when we see properties that we are looking to acquire or potential, property acquisitions, it's really the management is one thing that has to go. It's very rare. I don't think I've successfully spoken to anyone that has done a deal where they kept property management on. It's really has to, and I could be wrong with it with other people that have probably done that, but when I'm looking at a deal, I mean, that's usually one of the first things to go. It's property management going, and then the vendors that you're working with, or that previous owner and property manager are working with, they usually have to go too. And it's when you've had a property for many years, even if it's a few years through the last few years, and you've made money on it and there's no problem and your loan to value is like 40% now or something, you're not checking vendors every year, getting requotes on all your stuff. You're letting the property managers just kind of go ahead and do stuff and not really keep everything running how it should be. So I think it's a fault of the property manager, but it really comes down from the owner. And when you can find those properties and target them and identify them, that's the ones that are great to purchase and to just go in there. And even if you're not raising rents right away, you can go in there and you can really increase the net operating income by just fixing a lot of inefficiencies that are there.
Yeah, it's interesting. What do you find are some of the key inefficiencies that you find when you move into a property like that?
I would say number one would be you have the number one thing you'd see is a lot of vendors. We've gone into places before and we've had trash vendors that are 2-3 times what we could get it for. Landscaping's another thing. Laundry obviously is always a thing because it's something that goes on from landlord to landlord. So that's always something that you're reviewing in your due diligence process of when this is. They usually always have a terrible situation. So you're really, when can I upgrade this? You know what I mean?
Yeah.
Yeah.
In a 10-year contract.
When are they done? So I can put something in here that actually works for tenants so they don't have to be using coins, you know what I mean? And stuff like this. So that's part of it. And I think, there has to be, we talk about the property management and you're really talking about, the firm that you've hired, but really the people that are actually dealing with your tenants, that's something, you have to think, you have these multi-million-dollar complexes and the person that's really your contact between you and the tenant is someone that's not paid, they're $40,000, $50,000 a year kind of paid person. So you really have to handpick that person to make sure that they're incentivized to keep occupancy high, to find good tenants, and when issues happen, right, which they will and they always do, they're handled properly, and it's a good experience for everybody. It's a good experience for the tenant that they want to stay there, and it's a good experience. And you have all the pieces of your team put together, and the handyman's going to go out there and take care of things right away and address these needs. And if it's above their head, then they're calling a contractor, and this is all done quickly. And I think all that stuff goes into making property management really efficient and makes it profitable for the owners, but also it makes it a good experience. Because I've rented before, and it's something that you're like, well, I don't have any problem with this rent increase or this or that. They've done work here, but it's I have an issue with my AC all the time, and it's not being taken care of. Or so at that point you're like, okay, I'm just done with it because they're not going to fix it. They're patching it. You know what I mean? It's just and when you have been on both sides of that, and now you're just it just has to go. Has to be replaced, and that's how we're going to keep this tenant in there, and that's how we're going to keep it going is, spending money and doing what needs to be done.
Hey, Charles, how do you think about
that makes sense.
Impact on the investor side? Makes a lot of sense, thinking about on the ground with the tenants. But why do investors come to you? It sounds like you've probably built a lot of trust with them over the years, but what is it that you offer them of value, and how do you think that you sort of help move the needle for them financially?
I've passively invested. I passively invest more than we do active deals, and that's a great question, Dan. But I think that when we have investors that are coming to us to get involved in a deal, or they're looking for additional revenue, or to looking to diversify their portfolio, they're really, most people love real estate. They love the idea of real estate. I don't think I've ever talked to anybody and said, oh, real estate's a bad investment. It's just they don't want to become the landlord, right? So, and people don't know about the syndication. So letting people know, entrepreneurs and professionals, that, hey, there's another way of diversifying your portfolio out of the normal Wall Street type thing. And I think that's really important to let investors know and to explain to them exactly how the process works. And, honesty is always the best policy. I mean, you're going to have properties. And as we were talking earlier, Andrew, about the 5 and 7 year holds, which obviously we'd want to get investors out of those quicker if we went through what we've just been through for many years. But the thing, though, is that that's not always the case. So it's really always letting people know, hey, this is what's going on. And there's going to be bumpy months and there's going to be smooth months. And the whole goal is to really get that multiple for you on your equity at the end of the day. And that's our main goal. Number one is preserving capital. Number two is making sure there's no capital calls. And number three is making sure that the deal on the end of it is really coming out where we are at the same multiple. And during those months, there's going to be months where distributions are very strong. There's going to be months where we had collections that were lower and distributions might be a little smaller. And just letting people know up front that this is a business you're investing into. It's not like an annuity. And I think that's one thing. I don't think that's the thing that syndicators talk about much to their investors. And they're just like, oh, it's just going to, we pay you this much every year and every month and that, or every quarter, and this is how it's going to be forever. And it's not true, because you have different seasons, and you don't really know until you buy the property 100% what's going on there.
Yeah, that's really helpful. Makes a lot of sense. I agree. I think we found that transparency is something that investors really, really value. And so it sounds like that's something that you've built in your business. So kudos.
Charles, do you have a team that works for you? Do you have
so we have.
in your company?
I work with. I have 2 other partners that I work with, and then we have 2 other assistants that work with us, and they're working on all different sides of the business. Whether it's working directly with a lot of our marketing, and then also working. We have one that works with some of our investors to get them set up or to answer simple questions that come in. And it's really with my partners. Everybody kind of has a different hat that they're wearing between working on marketing, working on reviewing for acquisitions, or working with investors. So we found that to be the best, where you're teaming up with people that you have similar goals at the end with, but everybody has kind of their own special thing that they're best at. Just probably how you guys are, Andrew and Dan, right?
Yeah, for sure. Dan's way better at all things.
It's good to have one of those
numbers.
people.
So
I learned to count at a young age, and I've maintained the skill.
Yeah. It's a low bar to be better than me, Dan. Charles, you mentioned kind of like being good at acquisitions or investment. What would you say is kind of your thing that you really feel like you bring to the table?
I focus more on working with investor relations and working with a lot of investors. And as I mentioned before, like I do a lot of passive investing myself. So when I've been doing it for many years in syndications, and when you're working with so many different sponsors, you get so many different tastes of what you like and what you don't like. And I try to address investors' concerns and questions how I like to be addressed on the other side of the table. And I think it's a really big thing for people that might be working with investors. If they want to get into syndications, it's best to always start, I think, on the limited partner passive side and really find out how it works from their side, and then seeing what you like and what you don't. And it's simple things that syndicators drop the ball on, and I think one of them is communications. And I try to mark out half hour to an hour every morning of just working with investors, answering questions in depth to them, not short answers, and really explain to them where it's going, where the property's going. And then we're very open, as Dan was saying about transparency. That's a thing too. So if people are asking for any type of information on the property, and I have some limited partners that like to see everything. They like to see the weekly accounts of what got rented. If you want that, it's perfectly fine. I'll make a note of it, and myself or my assistant will get that sent over to you on a weekly basis, and you can see exactly who walked into the property, why they're not renting, why they are renting. And, you have people like that. Then you have some investors you guys probably know that you never hear from. You know what I mean? until they say, okay, great, wire me the money. You know what I mean? So you get a little bit of everything because people have different trusts, people have different backgrounds. Some people might be coming from a W-2 and they're a little iffy about it. They might be coming from an entrepreneur type background and they might be like, okay, like you handle it kind of a thing, and I'm putting this off to you, and just get back to me monthly and I'll review and I'll respond if there's an issue. So.
Yeah, that makes sense. And it sounds like you have some diversity in your investors in terms of their backgrounds, their financial wherewithal. What are some of the ways you're like attracting new investors?
Yeah, so we're always looking for new investors to work with that are interested in diversifying portfolios and getting involved more in commercial real estate. I would say some of the big ones we're doing is, as you mentioned at the beginning, so my podcast, and then also podcast YouTube channel that we have. We work on a lot with. We're on a lot on LinkedIn, and just really speaking to investors and kind of seeing exactly, putting out information there, and more of the kind of education type mindset. And then you'll have people that will reach out to you. And I do a lot of calls with people that are interested in being active or also being passive. Because, and I spoke to other syndicators about this and like, oh, no, I only want people that want to passive invest right now. Well, as I found, and Andrew and Dan, maybe you guys can agree or disagree with me, but I found that a lot of passive investors are also active investors. Now, obviously, probably not the same level. They might have just invested in 200 units with you guys, and now they're buying a duplex. You know what I mean? But they still have their foot kind of, in both areas. And they're kind of, they have their own investments. But then they also, hey, you guys have this great asset that they want part of in Atlanta or whatever it might be, and they want to have some diversification because all their properties are somewhere in Pittsburgh. You know what I mean? And so that's what I found too. So it's great to educate both ends because people are all different times. You talk to someone and 3 years later they might come back to you to invest because we've had that too as well. So
Charles, from working with so many different syndicators, I'm curious if you have a pet peeve of any syndicators that you've invested with. What's one thing that you kind of swear you won't do as a syndicator yourself?
I think just like, and I've had this, I think being more detailed with updates and information, be more transparent. And I've had some that like send you something and you're like, and it's, you can check it because every quarter or something I would request and be like, hey, send me like a rent roll or something like this. Because I just want to trust but verify kind of thing with certain people. But then you have some sponsors that are very open with it. And hey, here's balance sheets, here's bank statements. And that's how it was with the first syndication I invested with. And I like that. I like that idea. I like the transparency on there and looking through and seeing transactions and everything like this. And, over the next, I think, 12 to 24 months, if it hasn't happened already, we're really going to flush out a lot of people that don't have investors, let's just say investors, best in the front position. You know what I mean? They're kind of thinking about themselves and they're putting the investors on the back burner or on no burner. And I think you're going to see that come through when properties aren't as performing as well, because that's what's going to happen if there's any kind of pullback. And you'll see who the real asset managers are and who can really tackle issues at their property and have them come out the other end, because that's really what shows you who a good sponsor is and who a good operator is.
Yeah. No, I love your posture of what you provide to your investors and tenants is kind of what you expect from them. And I think my takeaway there really is two things I heard is transparency and communication. I think it's amazing the amount of time you spend communicating to your investors and making sure that you're transparent with them. And I think I heard that on the tenant side as well. When you move into a property and maybe you're subplanning a former property manager and maybe a former slumlord, you're communicating with the tenants and you're being transparent and trying to get the right unit for them. So that to me speaks volumes about the kind of impact that you're having.
And I think if people really want to have impact on their tenants, walk those units during the due diligence process. And you're probably not walking with the owner. You're probably going to walk with the old property manager or someone there. And they're not going to bother you if you ask the tenant 2 or 3 questions. And that's where you're going to really learn about, do you like this apartment? Are you going to, will you stay? Will you not? If you get a little information, and after you walk 100 units, you have a whole story about the property, and you have a story about how it was run, and hey, what don't you like about the property? would you stay if X, Y, and Z you just told me was corrected? And that type of information tells you how deep the problems are, because a lot of stuff you're just not going to know. You can walk units, you can review financials, but what I usually call is like the first 6 months of owning like a large apartment complex is like the initial stabilization period. And you're really just, bad tenants are out, and you're working on putting new tenants in there that want to stay, or keeping tenants that want to stay, and putting new tenants in there that are going to be, assets to the community, tenant base, and then also to the investors, because you have to serve two people on this. You know what I mean? And it doesn't work if you just do one, because you're just going to have tenants that don't want to stay, and you're going to have investors that don't want to invest with you again because you were playing it from the middle. And it's kind of, at this point, you really have to just make sure that you have tenants that are staying there for 2+ years, because we know as operators that's where the money's really made in multifamily. You can't have people moving every year. And then for investors, you want them to be comfortable with the investment and comfortable with the way and the direction it's going.
Mm-hmm. Yeah, makes a ton of sense. Well, Charles, fascinating discussion. I loved learning a little bit about your business and how you think about impact. I really appreciate that you take the time to walk through the properties and meet tenants and kind of boots on the ground. You're not in an ivory tower somewhere disconnected. You're kind of continuing to connect with the people that you serve. So I love that. Dan, why don't
Awesome.
you take us through the lightning round? We'll wrap up.
Charles, as you know, we like to do a little get to know you as a person here. So a few quick questions as we wrap up. Tell us about your biggest win, personal or professional.
I think my biggest professional win would be in 2009, I bought a completely vacant 5-unit building, and it was a mixed-use property. And within 3 months, I had it completely renovated, and I had it rented out. And I think that was, when I look back on it, it's crazier than when I was doing it. But that's what happens when you don't really know any better, right?
Yeah, that's awesome. Where was that?
That was in a small place where I had the original apartment in Connecticut, which is called New Britain. It's a little bit outside of Hartford. It's right between Boston and New York.
Cool. Gotcha. Well, it sounds like a great win. What is your favorite movie?
I think the original Wall Street movie is, because it shows greed, but it shows how bad greed can be if it's not checked. So it's something that, it's an interesting movie. I think a very interesting premise of how you think it's going one way and then it changes at the end and you get like a whole story out of it.
Yeah, I guess maybe you've used some lessons learned as you've built your career and your company. So cool. What's your favorite movie? I'm sorry, your favorite food. I just asked you that. What's your favorite food?
I'm Italian, so I would say pasta. Pasta is definitely a normal thing around our house.
Yeah, that's great. Current growth edge, what's something you're working on these days?
Growth edge, I would say that I think where we're really seeing growth and exceeding other people is through our referrals. And then I think where we're spending time on trying to build would be through LinkedIn and the marketing.
Okay, cool. And then other than the Global Investors podcast, what's some A+ content that you're taking in these days?
I love the website, especially with rising interest rates and everything like that. It's Chatham Financial. It's a great website, and it goes through anybody that's interested in commercial mortgages or commercial financing, anything like that, which is a huge part of our real estate business. It's something great to pull up every once in a while and see where stuff's going and seeing what you have to look out as an operator going forward.
That's a great suggestion. For what it's worth, I love everything they put out, and one of their biggest competitors is Pensford, and Pensford also has some great content, so I'd suggest that too. It's very similar type of content, but definitely worth checking out.
Awesome. Well, Charles, thanks so much for being on the show. If folks want to connect with you, what's the best way? I know you mentioned LinkedIn and the podcast, obviously, but if folks want to hear more from
so you can learn everything about our firm at harborsidepartners.com. And at harborsidepartners.com, we have a passive investing guide there. We have, all the podcasts, the YouTube, everything else you can find there. So we'd love to, reach out if you're interested in investing, whether actively or passively, and I get on the phone with everyone. So.
Awesome. Well, thanks, Charles. Really enjoyed the discussion, learned a lot about how you think of impact, particularly, as I mentioned, transparency and communication really stuck out to me. And also just being the boots on the ground, continuing to kind of interface with your stakeholders. So thanks for being on the show. Thanks to our guests for listening. And
thanks a lot.
We'll hear from you next time.
Thanks, Charles.
Thank you for joining us for this episode of the Real Returns Podcast. We hope that you learned something new about how you can invest to make a lasting impact on those around you. Please be sure to subscribe to our show wherever you listen to your podcasts, leave us a review, and share about us on social media. We hope you will join us for our next episode, where we will be continuing the conversation around impactful real estate investing.